Hello and welcome to a special interview for The Wire supported by Glenlivet Books. A recent article in the Indian Express has both been reassuring about the state of the economy, but it's also rung a few alarm bells. On the one hand, it says the belief that the Indian economy has slipped into its first technical recession ever is mistaken. But on the other hand, it suggests that in fact the hit to the economy could be much worse than most people have anticipated. Joining me now to talk about the article is its author, the head of emerging markets at JP Morgan Bank in America, Jahangir Aziz. Dr. Aziz, let's start with the recent article you've written for the Indian Express, where you've made some very important points. First of all, you point out that the widespread belief that with Q2 results, the Indian economy has slipped into its first ever technical recession is mistaken. It's based upon a false understanding of what constitutes a recession. Could you explain this point a little further, please?
Sure, Mr. Thapar. Even by economist standards, that's a pretty nerdy point that had to be made. But the reason why I had to make it is because the discourse in India was being based, as you pointed out, on something that was, misleading and could lead to, making wrong conclusions. So let me start off with just the headline numbers as printed by CSO. So in the first quarter of this fiscal year, India's growth rate was minus 23.9. In the second quarter, it was minus 7.5. Now, if you just look at those two numbers, then it would suggest that growth fell, not just growth, the GDP declined by 24% in the first quarter of this fiscal year, and then it continued to fall in the second quarter by 7.5%. So the level of GDP has continued to fall. Now, the problem with those two numbers is that, those numbers are based on what happened in the first quarter and the second quarter of last year. So for me to get any sense of what has happened between the first quarter and the second quarter of this year, I really need to know what happened last year to the first quarter and the second year. For example, if the second quarter of 2019-20 was by some miracle a very, very strong growth number, let's say it was a 10% or 15% growth rate, then even without the pandemic, we would have had a negative number in the second quarter simply because the second quarter in the last fiscal year was very, very high. So I think that, when you go into these kinds of measurements where you want to find out what is happening to the pace of the economy, to the state of the economy at present, you really want to avoid having a growth rate which is based on what happened the year before. It's almost like, driving a car where you don't really know what the speed of the car is at that point in time. Instead, what the speedometer tells you is that what was the speed of the car relative to what was the speed an hour ago. It's essentially useless. And economists, almost for 100 years probably knew about this problem. And if you look at what's happened over the last 30, 40 years, no developing market economy ever publishes numbers which are on a year-on-year basis. They publish numbers which is on a quarter-on-quarter basis. In fact, most of India's peers in the emerging market world also do exactly the same thing, including China. So if you look at what the National Bureau of Economic Research, which essentially defined the idea of how to term what is a recession, they basically said that if you have two consecutive quarters of negative growth rate, then you would call it a technical recession. The problem is that they had abandoned this idea of year ago growth rates, which is essentially antiquated, about 30, 40 years ago. And they were essentially thinking in terms of quarter-on-quarter growth rates. And if you look at India's quarter-on-quarter growth rate, which unfortunately we have to calculate it because the CSO does not provide us with those numbers, then India's growth did fall by about 25% in the first quarter of this fiscal year, and then rose by 21% in the second quarter. And the problem is that, if you go back to the minus 23.9 and minus 7.5, it gives a very misleading picture. Anecdotally,
just to simplify for the audience, because
sure.
a lot of people listening to you are not economists and they will get confused perhaps in the detail. What you're saying is that India calculates its quarter growth year on year, whereas in fact,
Right.
if you calculate it quarter to quarter, what has happened is that in the first quarter, as your bank has pointed out, India's GDP growth plummeted by 25%, but in the second quarter, it actually grew by 21%, as a result of
That's
which,
correct.
when you compare quarter to quarter, we haven't had 2 consecutive quarters of falling growth. It's only when you do it year on year that you get that impression, which is why you dispute the claim that India has gone into a technical recession. Have I repeated that in simple terms but correctly?
That's exactly right. And I think that, even anecdotally, if you talk to, people around you, they will tell you, yes, first quarter was really, really bad. You had 80% of the economy was under lockdown. But in the second quarter, businesses opened up, not as much as it would happen normally. More people went down to work. There were more activity taking place. But if I look at the CSO numbers, that's not the impression I get from it.
Okay.
Instead, what we have is that the economy plummeted in the first quarter and then continued to fall in the second quarter, which is very misleading.
But you have a very interesting codicil in your Indian Express article. On the one hand, you point out that the belief that India slipped into a technical recession is wrong. When you look quarter on quarter, in quarter two, we saw 21% growth compared to 25% plummeting in quarter one. But, and this is the important codicil, you say, this is not something from which one can draw much comfort. GDP, you say, is still 8% lower than it was before the lockdown began. That is really the key concern that people should focus on.
That's exactly right, Mr. Thapar. So think about, the fourth quarter of fiscal year. Imagine the number is 100 for, just argument's sake. So it fell by 25%. So the level of GDP went from 100 to 75 in the first quarter of this fiscal year. Then it grew by 21%. So 75 became 92. So even in the second quarter, we are 8 percentage points lower in terms of level of income than what we were in the fourth quarter of the last fiscal year. And that's a very large income loss. And it is, we often don't really care about the levels of GDP. We are okay with, just the growth rates. But when you have these kinds of large negative numbers, when you have an economy plummeting this much, the level of GDP matters. The level of GDP matters because that's what determines many things. For example, it determines how much loans you're going to get. The loan officer doesn't really care whether your income is growing by 10% or 5%. The loan officer really cares is what is the level of assets you have? What is the level of income that you have?
In fact, you take this point one critical step further. You say, and I'm quoting your article, even 6 quarters from now, GDP will still be about 7% below the pre-pandemic path. And you add in your article that this means an income loss of roughly $300 billion a year across 2 years compared to the pre-pandemic path. This clearly suggests that the hit to the economy is actually going to be a lot worse than people have anticipated.
Right. And, if you look at the debate, for example, the discourse more like that's happening elsewhere in the world, the discourse is not so much about, whether the economies are going to plummet. We all know, for example, US growth rate is going to plummet in the fourth quarter of this year. European growth rate will plummet in the fourth quarter of this year simply because there's a lockdown taking place, simply because infection rates are spiking. We all know that. The worry in the Senate, which just passed a $900 billion of stimulus in the US, is not so much to save the fourth quarter. That is going to happen. That decline is going to take place. What is important is what is going to happen to medium-term growth. Where does the economy recover to? And what happens in the medium term? And by medium term, I mean 6 to 8 quarters over here. What happens over time? And if you look at India's growth rate, broadly, India's growth rate in this fiscal year is going to be -9. In the next fiscal year, we have a projection which is probably much more than what consensus has. We have it at 12.2. If you look at the level of GDP at the end of fiscal year 2021, then it'll still be about 8-9 percentage points lower than what the pre-pandemic path was. And the pre-pandemic part, we are defining very broadly as about a growth rate of 5 or 6%. So compared to the pre-pandemic part, you will have 2 years of growth rate, of level of GDP or level of incomes, which is going to be 8 percentage points lower than what should be the path, which roughly translates into a $300 billion loss in 2021 fiscal year and in fiscal year 2022. And the question then becomes is that India does not even complete a recovery, perhaps not even in fiscal year 23. So we have a very, very long way to go. The income losses is going to be very, very large. And it is very surprising that where in the rest of the world, there is an enormous amount of concern and debate and discourse, and policies are being formulated because they're afraid of incomplete recovery, both in Euro area, including in the US, almost in every other emerging market country. In India, we seem to be obsessed with these year-on-year growth numbers, and we either take comfort in it or we berate it.
Absolutely. So for the sake of the audience, let me at this moment pause and point out what I meant in that introduction when I said your article is both reassuring about the state of the economy, but also rings alarm bells at the same time.
Yep.
The reassurance comes from the fact that the belief in India that we've slipped into a technical recession is mistaken. We have not. In the second quarter, actually, the economy did grow. It's just that it plummeted so much more in the first quarter. But the alarm bells arise from the fact that it could take us 6 or 7 quarters to come back to the pre-pandemic path. And in the process, we will have lost, as you roughly estimate, $300 billion a year over 2 years of income. And that is a fact that hits to the economy, which is a lot greater than most people anticipated. Let me then at this point, Dr. Aziz, come to the second important issue you raised in that Indian Express article. You point out that on the one hand, the government has refused to provide income support, claiming that it doesn't have the fiscal space to do so. But on the other hand, you point out that the private sector's excess savings are so large that India is actually investing abroad. And this means, you say, that the RBI has been funding other countries' fiscal deficits. And since April this year, that's been to the extent of $70 billion, or roughly 2.7% of our GDP.
Right. So if you think about the economy, right, and you look at, what private sector is doing, what the government is doing, the private sector earns, saves, invests, the government earns taxes, spends on consumption, invests. And if you add up all of these savings of the private sector, which includes both households and SMEs and corporates, and that of the government, you get what is called the national savings. And then the nation invests. We, for example, invest around 33% of GDP right now, last year, for example. And most of the time, and this has been India's problem, right from the beginning, that our total amount of domestic savings, including both that of the private sector and the government, has never been enough to cover our investments. We usually run what economists will call current account deficits. Basically, we are borrowing from abroad. Typically, our current account deficits are about 2%. If you remember back in 2013, when we had the taper tantrum, our current account deficit went up to about 5%, and that's what rang the alarm bells, and that pushed us to a mini crisis. But typically, we borrow from abroad in order to fund our investments. So if you look at 2019, we were running a current account deficit of 1.5% of GDP. So we were borrowing from abroad 1.5% of GDP in order to fund our investment needs because our savings was not enough. If you look at the first quarter of this fiscal year, we ran a current account surplus of 4%. And my own economist projects that 4% is too high, it will actually come down. But for an average for 2020 this fiscal year, we are going to have a current account surplus of 1.5%, which means that while in general we would borrow 1.5%, now we are actually exporting savings. We have excess savings of 1.5%. So what are we doing with the excess savings? We are pushing it abroad. That's what we usually do with excess savings. We buy foreign assets. In the case of India, because of India's, the way in which Reserve Bank of India operates. It's the Reserve Bank of India that is intervening in the foreign exchange market, and it is buying dollars and is taking those dollars and is investing. What does RBI invest in? RBI usually invests in liquid treasuries, US treasuries being one of them. But in reality, that US treasury is essentially funding the US fiscal deficit. So that's the odd part, that the excess savings is so large that the RBI, at least the RBI, is funding US fiscal deficit, whereas our own government is saying that they do not have the fiscal space to increase their spending or the support for the pandemic.
Let me then point out a conclusion that will occur to the audience, that we have a very peculiar situation here on our hands. On the one hand, the government refuses to increase expenditure domestically at home, but on the other hand, the RBI, or the government via the RBI, is actually investing 2.7% of India's GDP in foreign assets. And many people listening to you will say, just when we need the money to be spent here, we're actually not spending it in India, but we're facilitating investing it abroad. And that suggests to people that the government's got its priorities wrong.
Look, I mean, it's difficult to say, where the government has got its priorities wrong, because that would imply that I know what the government's objectives are. So, it's hard for me to say that what the government's policy is not consistent with his objectives, because it's difficult to understand what the government's objective is. If you go and look at other countries' fiscal, India is not the only country that has a pandemic. Every country has a pandemic. India's own peers have gone through worse infection rates, Brazil being one of them. And if you look at what has been the focus of the policy has not really been trying to lift up demand in the near term. You can't do that. If the economy is in lockdown, if people cannot go out and work, if people can't do anything outside, then there is very little that the government can do to lift up demand. You basically, depending on online purchases, that's about it. However, what is problematic is that people are not going to earn money, and therefore they're going to actually save from their savings. And that is the worrisome part. That what the Indian government needs to do is to provide support so that people do not bring down their savings, particularly households, particularly the poorer households and the SMEs. Because if they do that, and this is where it becomes slightly problematic in terms of the debate that is taking place in India, if suppose we do that, if people truly, and my sense is that people are doing that, people are truly drawing down their savings, both the SMEs and the households, then let's say we do get a vaccine rolling out, things normalize, all good things happen. But the point at which good things will happen, people will not have the net worth, the balance sheet to support the recovery.
Can I stop you there? Because you're going into another point that I think is critical, and it flows in your article from the first point. But for those who haven't read your article or are not familiar with economics, let's take it in two stages. Because what you're saying is that side by side with the government refusing to provide income support, you also point out in your article that wages, employment, and earnings of SMEs have plummeted. Right. And also simultaneously point out that the Center for Monitoring the Indian Economy has recorded that something like 10 million jobs have been lost. And so the first conclusion that emerges is that balance sheets of households and SMEs would be in dire straits. These are people who are completely strapped for cash, they're eating into their savings, and they're in a very, very unhappy position.
So there are 2 points I would make, Mr. Thapar. So let's start with what else has been happening in the economy. So let's take the second quarter. The second quarter, India's growth rate was -7.5%. Let's not contest whether that's the right way to measure or not the right way to measure. So India's entire income fell by 7.5%. That's what the CSO tells us. At the same time, the Reserve Bank of India produces, what is the profits made by listed companies. And if you look at the RBI's data, the listed companies made a profit of almost 30% in nominal terms, roughly 20% in real terms. So if you think about the overall economy, the listed companies in that overall economy actually had their profits increased by 20%. So if the overall economy went down by 7.5%, and if one group of company, one group of that economy, which is the listed, which are the listed companies, they had their incomes go up by 20%, then the rest of the economy's incomes must have fallen massively, such that the average income fell by 7.5.
And that is, in fact, a hit to wages and a hit to SMEs
That's
in particular, which is why
absolutely.
household balance sheets and SME balance sheets are in dire straits. Those are the ones who've lost, just as corporate profits have increased.
Right. And if you think about how does corporates make so much money in a period when incomes have fallen by overall average growth has fallen to about by 7.5%, you do that by reducing employment. You do that by not investing. And so this is sort of the problem that we are facing, where each individual companies, makes it very rational for them to cut back. But if every company does that, then we have, the tragedy of commons, where they themselves are killing the goose that will lay the golden eggs, about a year from now.
Absolutely. It may be rational for one company to lay off staff to stop paying salaries, but if every company does it, you have a huge unemployment problem. You also have a demand problem. And that's where you make your next point. You say that if the government doesn't act immediately to help households and to help SMEs, then by the time a vaccine makes recovery possible, we'll actually have a financial crisis on our hands. And that financial crisis will impede the recovery that we're waiting for.
And this is where I think where the government's strategy runs into problem, right? So if you're focusing completely on the near term and you're not thinking of what is going to happen over the medium term, then you run into this problem where right now none of the losses and none of the hits to the balance sheets are showing up. Why aren't they showing up? Well, they're not showing up because the Reserve Bank of India has extended forbearance, which is basically telling banks, look, you have to allow people time.
The moratorium.
You don't have
they call
moratorium.
It the moratorium.
No, exactly. So if there is a moratorium, there is those things are not going to show up in state data in the bank's balance sheet. So we will not know what the size of the hit is. But as I was pointing out, that the hit to the non-corporate sector had to be very, very large if numbers have to add up. And you go through this period of time. Let's say we have this vaccine rollout, etc. And let's say that we are lucky enough that by the second half of fiscal year, we get to a point where we hit herd immunity and we can truly start normalizing behavior in the way in which things used to happen before the pandemic. That's the time when people are going to go out and start spending in earnest. That's the time when people are going to go out and invest in earnest. SMEs are going to start building up the businesses. But if that's the time when banks look at their balance sheets and says, look, your balance sheets have gone down, have been impaired, has been destroyed because of the savings that you did over the last 18 months. And the bank said, look, we can't provide you with any loans or any credit because of you do not really have the collateral. Then those people cannot participate in that recovery process. And again, I find it very, sorry, go ahead.
It's a simple point you're making. You're saying that, in fact, if people are eating into their savings to survive, if SMEs are running down their balance sheets, if the moratorium ends and people find that they're in debt which they can't repay, you'll have a humongous financial crisis just when recovery is beginning and you want people to spend. Which is why your advice to the government, and again, I'm quoting from your article, is an extensive income support now.
Right.
But the problem is, that's the one thing this government doesn't seem to be doing. You suggested a moment ago that they're being short-sighted. How do you convince them that this short-sightedness would actually mean they're creating a financial crisis which they could avert? And that financial crisis, when we want a recovery to take place 6 months, 8 months down the road, will actually prevent the recovery happening. How do you convince the government that this is unwise on their part?
Probably I won't be able to convince the government very much because I'm sounding like a broken record now. I've been saying this since the beginning of the pandemic back in March, that the way in which you address this issue is not by the way in which you have addressed the crisis in the past. So if you go back into history, let's say the last 40 years, whether you're looking at India or emerging market, every debt crisis, every financial crisis in emerging markets, including in India. So you start with the 1980s Latin American debt crisis, the 97 Asian financial crisis, the 95 Mexican crisis, 99 Russian crisis, our own 81-82 crisis, the 91-92 crisis, the 213 crisis, all those crises were exactly the same. 2-3 years before the crisis, you have very easy monetary policy, very easy fiscal policy, and people start spending, people start investing in things that they shouldn't be investing in. For that 2-3 year period, lots of foreign capital comes in because things are looking good. You're investing in asset prices are going up. And then in about 2-3 years later, suddenly, foreign investors reassess the economy and they decide we are not going to fund this economy anymore. Economists call it a sudden stop of capital. When that happens, we start off with a financial crisis where balance sheets of corporates, balance sheets of households come collapsing down. And then the government has to react to it by tightening policies. We did that in 2013. We raised interest rates, we tightened fiscal policy. And then you restructured the banking sector, restructured balance sheets. The economy goes through a massive, painful economic adjustment.
Sure.
And then after a 2-3 year period, you get a recovery going. The problem is that this pandemic is exactly the opposite of that. In all of these previous episodes of crisis, there was a financial crisis first and an economic adjustment later. If you look at this crisis starts off with an economic shock. Shock that is nothing to do with policies. And the question is that whatever playbook you had, which was based on all the other previous economic crises, though that playbook doesn't work anymore.
Absolutely.
And you have to do almost exactly the opposite of what you did in previous crises.
And the government
you
is
have
not.
to,
And the government
right,
is
and government isn't. And you have to ease in a crisis, something that we have never done. We've never eased in a crisis.
Which is where we come to, in a sense, the second paradox of the situation. The first is that instead of spending and increasing expenditure at home, the government seems to be facilitating the funding of foreign deficits, and therefore money that should be used in India is actually going abroad. But there's a second paradox. The government is clearly an intelligent government. It can see that with households in distress, with SMEs in distress, there is a financial crisis looming, and it'll hit us when the moratoriums end. Worse still, it'll hit us just when the vaccines have permitted a recovery to happen. And yet, although this is there looming on the horizon, the government is doing nothing about it. And that's the second paradox. And the explanation that many believe, and I want to put that explanation to you to ask if you agree with it, is that the reason the government is not increasing its expenditure is because it's concerned about how rating agencies will respond to a ballooning fiscal deficit. Now, the question I want to ask is this. In the present circumstances, which the ratings agencies understand as well as the government does, will they applaud the government for fiscal prudence, or will they say this government was very unwise not to have provided income support and avert a financial crisis? Which will be the response of the rating agencies, to applaud or to say this was a short-sighted government that's created a crisis which could have been averted?
Again, Mr. Thapar, I mean, this is something that we've already gone through. So if you go back to April, the rating agencies showed its hands. So if you go back to April, there were two rating agencies. One rating agency downgraded India from a one notch above investment to investment, and the other rating agencies kept the outlook stable. Now, the problem is that we only look at the headlines, we don't look at under the hood. So if you looked under the hood of those two rating agencies' actual analysis, almost every number that the two rating agencies had regarding, let's say, this fiscal year's growth rate, this fiscal year's fiscal deficit, what was going to happen to inflation, what was going to happen to current account deficit, were identical. There was only one difference. The rating agencies that downgraded India had a 1.5 percentage points lower medium-term growth, and the rating agencies that kept India's rating stable had a 1.5 percentage points higher medium-term growth. The rating agencies have already said how they are going to judge this crisis. What the policies that you take, the way in which you respond to it, will be judged not with what happened in 2020's fiscal deficit. Every country under the sun is blowing up their budget. Brazil's budget deficit is going to go from 6% to 14.5%. US has a fiscal deficit close to 15.5%. Every country under the sun is blowing up the budget. Every rating agency understands that.
Except
the question
India is the outlier. And what you're saying is that rating agencies will look at India and say, you did precisely the wrong thing. You did the opposite of what was required.
Again, the Indian government could well be right. Maybe this is the right policy to do, and the rest of the world could be wrong, and the rest of the world's medium-term growth could actually fall. But as I said, if I look at what the lack of income support, what it's doing to balance sheets, one of the last things that you want to do as an emerging market country is to have impaired balance sheets, because just from history that it takes a very, very long time once balance sheets get impaired to get out of a crisis. And so I think that it's likely that when the second half of 2021 happens and we get to know what has been the damage to balance sheets, many of these rating agencies will look at India's medium-term growth. So not in 2021's growth, but in 22 and 23 growth, and say, look, we need to bring down India's medium-term growth. And once they do that, then every indicator of debt goes out of the window.
Well, you again said something very important, that come the middle of the next financial year, when vaccines are permitting a recovery to happen,
yes,
far from the rating agencies being pleased with India's prudence, they'll actually say, hang on, you've impaired your medium-term growth, we're going to bring your rating down, and as a result, the government will have achieved the exact opposite of what it thinks it's doing. At the moment, it thinks it's pleasing the rating agencies, getting plus points and brownie points from them. Instead, it's actually going to make the rating agencies lose a bit of confidence in India's growth capacity.
And imagine, when do you want to blow up the budget? If you have to blow up the budget, blow it up when everybody else is blowing it up. You're just going to be one of the other guys in the middle of the pack who's blowing up the budget. But imagine when in 2021, when every country under the sun will be consolidating. They will be bringing down the budget deficit because they spent a lot of money in 2020. And if India is the only country that is forced to start supporting banks because banks have to be recapitalized, or income support to people because people's incomes have been, balance sheets have been impaired, then India sticks out like a sore thumb. That's the only country that's expanding its deficit when every country under the sun is consolidating. So even tactically, I don't understand the government's sort of tactics that if you really want to spend money when everybody else is spending money, and you're just going to be one of the other guys who just spend money, right?
You're saying again something that's very important. India is getting the worst of both worlds. We're getting the worst of the world at the moment when we should be expanding the deficit and giving income support. We're not. We're letting a crisis develop. And when that crisis develops and we have to throw money at it in a big way, we'll be doing it at a time when the rest of the world is actually...
That's good. That's exactly right.
We get a double whammy against us. And the point I want to make is this. The only way the Indian government strategy can turn out to be right is if what the rest of the world is doing turns out to be wrong. We can always hope that we're the only country that's got it right. 180 have got it wrong, but it's unlikely that will be the outcome.
Well, I mean, history teaches us that, yes, I mean, that is unlikely to be the case because, as I said, You really can't have $300 billion of losses for 2 years and not imagine that some people's balance sheets will get tattered if you have a $300 billion loss. And it's not just balance sheets getting tattered. Imagine what it will do to inequality, to poverty, to the gender gap. And I think these are going to have very large medium-term impact. And again, that is not where the discussion in India is. But if you look at elsewhere, concerns about inequality, concerns about poverty, concerns about the gender gap, it is not in the number one and number two in the public discussion, but it's clearly in the top 5 of the public discussion, including, by the way, in the IMF's last World Economic Outlook. That was their concern.
Absolutely, Dr. Aziz, I want to thank you for having explained in such careful, meticulous detail the nature of the crisis that's looming on the horizon, one that you can see, one that Pranab Sen in an earlier interview with us also identified, but one which our government, for reasons that no one can understand, either will not see or will not respond to. And it means that we're likely to end up with the worst of both worlds. I hope that the interview you've given me is picked up by the government and awakens the government from the slumber that it seems to have slumped into. Thank you very much indeed for this interview. Take care. Stay safe.